you approaching tax season with a sense of dread? Well, here to talk with me about this is Maryann Vognild from Buckingham Strategic Wealth. Maryann, welcome.
Thanks, Bob. I really appreciate being on the show.
Pleasure to have you here. You recently wrote an article for Retirement Daily about this very topic. We're eager to have you walk us through it.
Yeah. So, one of the things, and I will fully admit that this used to be me, that's very interesting about taxes is that you can look at it and think, well, I don't know what it's going to be. Might as well just wait, roll the dice, see what happens come April when I'm filling out my tax forms. But the reality is that the tax code is very, very structured and it's knowable. And if you know what your income is going to be, then it's possible to project your taxes. And you can use that to impact your daily life by increasing your cash flow or figuring out if there's some techniques that you can use to lower your overall lifetime tax by planning for what you already know.
Hmm. So as you think about the steps to do this, walk us through those steps.
Yeah. So what I consider tax planning, and different people use that term to refer to different things. What I consider tax planning includes being able to project your income for a given year, take that projection, apply what you know, and make decisions that can either increase or decrease your income that will be taxable, and then use that as a long-term planning process to make decisions for multiple years in a row. And that process, can be as simple as, hey, all I get is one W-2. I just got a raise. Why don't I go to the IRS website, put in my stuff and see if I need to change my withholding or if I can just leave it as it is. And if you do that, you may find out, you don't have to withhold quite as much, or maybe you need to withhold a little bit more so that you don't owe a lot of money at tax time. And by doing that, you don't end up in a position where you get a lot of money back that you didn't expect, or you owe money when you didn't expect it. This can also be used if you're retiring early. Let's say you retire at 55 and you say, well, I don't have to take a lot of income right now. I have an IRA. I have Social Security coming in the future. I'm going to have all these years where I hardly pay any taxes at all. Well, that sounds like it might be a really great benefit. However, if you do that, if you have a tax valley, as we might call it, what that means is that you're giving up the benefit of those lower tax brackets. And then if you wait, you don't take any money until you turn 70 or 72 for Social Security and then required minimum distributions, you may end up being in a much higher tax bracket than you otherwise would be. And if you could have taken that tax out in today's rates of like 12%, and instead you end up paying 22 or 24, or as Bob, I know you and Jeff Levine have talked about, how the tax rates under current law are going to go up in 2026. Since we know that, you could end up in the 28% tax bracket or even higher in that post 2025 world. And nobody wants to be there. Why not take advantage of the 12% now, maybe even the 22%, and pay, save some money in the meantime.
Yeah. So there are some common pieces of information people need to know. Adjusted gross income, modified adjusted gross income, combined income. I mean, we've got a lot to go through.
Yeah, there's a lot of stuff there, and a lot of those things. If you come across something and you say, I have no idea what this is. I'm looking at this. Maybe you're not an early retiree. Maybe you're someone who's who's already 65, and you're considering, do I take my Social Security now? Do I wait? What do I want to do? There are these pieces of information that you need. As you were saying, adjusted gross income. It's what if you look at the tax form, it adds up all of your income, and then it says, here is what we call your total income. There's a few pieces that they take out, like IRA contributions. Those come off before the adjusted gross income. But as you said, modified adjusted gross income is, every program, whether it's a tax credit or, the Affordable Care Act subsidies, those things all have their own modified adjusted gross income. And what that usually is they take that adjusted gross income or AGI number and they add something back to it. In the case of the Affordable Care Act subsidies, they add back non-taxable income. For the purposes of, a few other things, they may add back things like whether or not you took an IRA distribution. For the there are other things like the child tax credit. All of those things have their own modified adjusted gross income. And so you need to look that up by each program that you may qualify for. And so a big caveat that goes along with this article, and a big thing, the reason that I didn't get into actually demonstrating a specific technique, is that every single person has their own process that they need to go through. This year, my child is 17. She still qualifies under the current law for the child tax credit. Next year, I'll be looking at something else. And so that will be a completely different situation. And I have to take that into account when I do my own tax planning.
Yeah. Talk a little bit more about the knowledgeable decision-making that needs to occur.
Yeah. So again, your situation. If you have an advisor, your advisor should know your situation. A perfect example is that two people sell their business in the same year. Because their situations are ever so slightly different, where they sit with their regular taxable income, they may end up having to make different decisions on what is a good tax rate to pay. And so, I'm thinking about two business owners that were actually partners, but because their situations were different, one decided, what, I want to pay all the tax in year one because I'm afraid that tax rates may go up. Another decided, well, if tax rates go up, they've said it's not going to impact me because I am not the majority owner of this business. So I can spread my tax burden out over the next few years. And being able to look at their individual situations, know where you're starting, and then add that income and compare, what if I took it all in year one? What if I took it over the next 3 years, or whatever the situation may be? You're able to actually make a decision that is the best for you, rather than being a rule of thumb decision. And I think that really goes to a lot of the planning techniques that, Bob, you and the people that you interview here use. It's really easy to paint a broad brush, but that doesn't actually look at the details that each individual person has.
Yeah. There's a concept that you write about in the article that I'm fond of too, which is this notion of lowering overall lifetime taxes and not thinking about it in a single year, but perhaps what it might be averaged over, I guess, a number of years.
Yeah, and I think that's a big thing that is really important. If you can fill in those valleys, as I talked about before, if the valley is in the 0 to 12% tax bracket, and you do everything you can to keep all of your income below that, or then that's inexpensive for you. However, there might be some people where if you project out your income and you look at it and you say, well, in 2026, I'm going to be in the 28% tax bracket. Well, then that means that anything that you pay below 28 right now is going to be a cheap dollar. And if you can do that now in the next few years, that puts you so much farther ahead than where you would be if you waited and just paid 28. And of course there are benefits to deferral, but if you can, a perfect example is if you can do a Roth conversion. I'm not talking about an all or nothing Roth conversion where you take the entirety of a retirement account and you shift it over in one fell swoop. But if you can do a Roth conversion to keep you in a low for you tax bracket, then that Roth conversion can end up saving you money over the long term, because you still end up getting a similar deferral after tax, because that Roth account, once it's in there, any earnings in that account, you don't pay taxes on. And then you can choose to use those Roth dollars over the next however many years for things that would be above and beyond what your normal income would pay for, whether that's cars or trips or things that you purchase not all the time, not every month, but on one-off situations.
Mm-hmm.
So.
In the article, you mentioned some pitfalls that can cause some higher marginal tax rates that people should be on the lookout for.
Yeah, I was actually looking at a situation yesterday where someone had, they were at just that point where their Social Security was beginning to be taxed. So Social Security is a great example of one of those things that can come back. And again, every single person's situation is different, but Social Security starts off as being not taxable, then half of it's taxable, and then 85% of it's taxable. And so in this case, the person that we were talking to, if we did nothing, they would have a negative taxable income. And so what that means is that they could have, in this case, about $9,000 of additional income that we could generate for free. They could generate income and not pay any tax on it. And that's a wonderful place to be, especially if your state follows federal laws and your state income tax is generated by that. It's great. But because they were in that Social Security phase-in, for every $2 of income, an additional $1 of Social Security became taxable. So if we had just added $9,000 of income, what that would have done is it would have added $13,500 of taxable income, and that would not all be free. So instead of being able to add $9,000 of income, we could only add $6,000 of income, and that's a great place to look at things, make sure that you've got everything, that everything, and that you're using a calculator that takes some of those things into account. Another thing to look at is Medicare IRMAs. Mm-hmm. Which are, for higher income retirees, can really come back to bite them. And the hardest part of that is that at the time you're trying to plan for it, you don't know what the level is going to be exactly. So we, just a few months ago, as we finished out 2021, we were looking at what do we think the IRMA level is going to be in 2023, because that is based on 2021 income. And so we needed to try and target a place where we thought it was going to be. As other people have said and talked to you about, Bob, I think Patrick Custer was on here, and he said, you don't know where you're going to end up. And if you just end up $1 over the line, suddenly you have to pay many, many thousands of dollars in premiums. Yeah. So, keeping those things in mind, if that's a place that you're potentially getting close to those targets, which, I'd check it as you're doing this tax planning. Those things are really important.
So it's not that someone couldn't do it on their own, but it seems like having a professional, if only look over your shoulder as a sounding board, might be appropriate given all the things that could go wrong without because you weren't, because you missed something.
Yeah. I mean, certainly, if you're using a piece of tax software, there are usually projection tools in there. Some of them are better than others. You can certainly do some simple things like W-4 withholding on the IRS website. But as your situation gets more and more complex, find a professional and then make sure that they're going to be able to do this for you. If this is what you want, make sure that they're going to be able to go through the process and get you to the point where you can effectively prepare your tax return the fall before the taxes are due, so you can do all those planning steps in advance, and it's all known. It's not impossible. Certainly, many of the things I do as an advisor are not impossible, but you have to have the time and energy to try to put into it.